Hello, welcome back to the show. So in today's video, I'll be talking about the most overvalued stocks in the market today. So in today's video, I'll be covering two things. We'll be covering the most overvalued stocks in the market, as well as the AI capex bubble that is potentially going bust for all your different hyperscalers today. So the first stock that I'll be talking about is none other than Palantir. So Palantir is a stock that is up 80% this year and currently trading at around a 659 times earnings. That is almost just unheard of. So for Palantir over here, if you're to look into their Q4 earnings, this is their Q4 earnings. Q4 earnings came in at around $79 million of net income, of which 54 million of that came from net interest income. And then if you're to look at their entire 2024 earnings as well, their earnings came in at around $467 million, and about half of that came from their net interest income as well. So overall for Palantir over here, not a lot of money is coming in from the business operations itself. It's more from the interest that they're generating from the float and from issuing a lot of shares over here. So if you to look at Palantir's share dilution, this is just crazy. They've been diluting shares almost every single quarter since about 2 years ago, while their insiders have been selling out their shares almost every single quarter as well. So if I'm a shareholder of Palantir today, this is shareholder dilutive. This is not good for our shareholders. But for the business itself, it is actually not a bad choice for them to dilute the shares now because the shares are vastly overvalued. And when your shares are overvalued, it's better for the business to just issue out more shares so that they get more cash and get more net interest income from that. So for Palantir over here, the summary is this. Palantir is simply too expensive at this price. It's currently trading at a 600 times earnings. It's hard to justify and do a deep dive for this one. Next stock is FICO. So Fair Isaac over here is currently a stock that's trading at around a 90 times earnings, and year to date is actually up after being down by around 20% at one point this year. So for FICO over here, this is their monopoly. It has a monopoly in your consumer debt and your rating section. So what they do is that for every single consumer that wants to get a mortgage loan, that wants to get a car loan, they need to get a FICO score first to assess their credit worthiness. And the only notable company that is able to produce these scores is FICO. So FICO over here, they raise their prices like crazy because they can. They raise their prices on credit bureaus, and then the credit bureaus, what they do is they will just pass on the prices to the consumers over here. It is an absolute monopoly and a stock that I would like to own, but the problem is the valuation itself. So for FICO over here, the pricing power is just incredible. This year as well, they're planning to increase their prices from $3.50 to around $5. That's around a 30% hike in the prices just in this year alone. So imagine if their volumes just stay constant and you increase the prices at 30%. That's already a 30% earnings growth for FICO over here without having to deploy more capital into the business as well, because your FICO scores, they're almost at around 100% operating margin. So for FICO over here, this company ticks most boxes: pricing power, monopolistic, great management as well in terms of their capital allocation. But for me, I think FICO is just a stock that is too expensive at current pricing today. So if you have to look at FICO's valuation over here as compared to all your other financial information companies over here, FICO is currently the outlier of all these stocks over here. It is the company that is growing the fastest, but the problem is simply just the valuation. So I think out of this list over here, there are much better buys in Moody's, MSCI, S&P Global, even Equifax, although Equifax is a company that is not extremely monopolistic. But these companies over here are simply just presenting a much better opportunity as compared to FICO today. So my summary is this: for FICO, I'm sitting out. I'll wait till it reaches around $1,300. It's crazy expensive at this price, and the assumption at this price is for the company to grow at around 30 to 40% for the next 10 years or so. My belief is that no company can do that for 10 years plus, and the returns for FICO are likely already priced in. So when you have so much valuation expansion and not as much earnings growth, you will likely see a multiple contraction in the future when the growth slows, and that is what you see with FICO. Another concern for FICO is that they're simply increasing their earnings from pricing. So if the DOJ comes after FICO, if the DOJ sees that FICO does all these different price increases, being a monopoly in the sector, you could see some regulations being placed on FICO over here simply because it is too strong, it is too much of a monopoly. So for me, I think FICO, it's a company that is extremely good. It's a high quality business, but simply because of the valuation, I'm sitting out right now. Next stock is Palo Alto. Palo Alto is a company that is in the cybersecurity segment over here. This company is trading at 100 times earnings, and year to date is up around 5%. It's one of Nancy Pelosi's favorite holding over here, one of the hype stocks that she owns. So for Palo Alto over here, so if you were to look at the market share of the entire cybersecurity network over here, this cybersecurity segment is extremely fragmented. So you have Microsoft 11%, Palo Alto at around 4% only, and the next biggest player after Palo Alto is Alphabet at 3.4%. So The problem with cybersecurity as a whole is cybersecurity is evergreen, but the problem is there is no clear winner in this space. All these cybersecurity names, they are all trading at a premium as compared to the market. So Palo Alto is trading at 100 times earnings, CrowdStrike is trading at around 600 times earnings, Zscaler is not even profitable yet, and the only one that is providing some sort of value proposition is Fortinet, but Fortinet itself is also trading at around a 50 to 60 times earnings over here. So it's far better to buy a stock in an industry with no competition. And for me, I think cybersecurity is just too fragmented. There's no clear winner in this space, and that is the problem with it. Next stock is Costco. So Costco is currently a company that is trading at around a 60 times earnings, and year to date, this company is up as well, even with such a high multiple. So for Costco over here, it is like Amazon. It is focused on customer satisfaction. Their business model is just fantastic. So what they do is they try to lower the prices on their goods as much as possible, so that the consumer, they are so attached to the brand itself, they're so attached to Costco that they sign up for the Costco membership. That Costco membership is almost 100% margin. So for Costco over here, the Costco membership business model is just an incredible business model because it has predictable cash flows, predictable earnings, and they can increase prices every single year if they want to as well. Because the value proposition from that portion of the business is so good that the consumer won't just cut off the Costco membership. So for Costco over here, the problem with this business is the same thing, the valuation itself. So the past few years, most of the returns actually came from the valuation expansion as compared to the earnings growth. So earnings growth over the past 5 years has been around 12% or so, but the valuation, the multiple of this stock has just expanded. So from 2022 of around 35 times, the lowest point, up to today, it has almost doubled in valuation already. And I think this stock is just primed for multiple compression when the growth slows. Next stock is Tesla. So Tesla is currently a stock that is trading at around 154 times earnings, and year to date is down around 25%. From its lows, it's already up 20%, and from its highs, it's down around 40 to 50% or so. So for Tesla over here, it is a sentiment stock. The underlying core business of Tesla is slowly dying, but the investors care more about the story rather than the actual numbers of the business. Their EV sales are dropping, so if you have to look at the EV sales in Europe, in China, in US as well, all those different segments, they are all decreasing. This year itself, in Europe, they reported double-digit decreases in most of the European countries, except for one country, I believe. And overall, the only thing that is keeping Tesla stock alive today is the robotaxi story. So for the business over here, there's another problem as well. This is called key man risk. So Elon Musk is the key man risk because he is the salesperson. He's the leader of this company, but the problem is Elon Musk is not a part-time CEO. So he has other ventures as well. He has his XAI, he has SpaceX, he has his Doge as well, and then he has Tesla as his business as well. And the problem with this is he's a part-time CEO. He is not so focused on Tesla, and that is why shareholders have been selling off the stock ever since he went into Doge. So another thing to take note of is that Tesla has almost zero capex. So if you have to look at the capex numbers itself, capex is at 2 billion last quarter, and if you have to compare it to all your different hyperscalers like your Meta, Google, Amazon, Microsoft, this capex number is just crazy low considering that they're planning to build up the biggest fleet in the automotive industry over the past 10 years or so. So fundamentally, this stock is unsound. It's a momentum stock that everyone loves, but for me, I'm sitting out of this one as well. Last portion, I'll be talking about the AI capex bubble over here. So this user over here, Kenneth, he said, "Thank you for your sharing. I just feel that your bear case is the lowest valuation of the bull case. In a real bear scenario, earnings contract or even turn downside to losses. In your case for capex considerations for cloud, they might not recoup this capex in a while. A good example is Meta in their augmented reality and VR investments. Also, customers may revert to self-managing and set up their own small-scale data centers for data sovereignty and more controls, resulting in lesser spend on cloud. Tech innovation may also render all this capex never ever recoverable. One example of what might happen is new R&D, resulting in AI becoming much cheaper with cheaper hardware from other companies. If hyperscalers bought hardware at 20 billion but on par only with new hardware priced at 10 billion, it's a huge blow. They'll be forced to push prices down and may even have to write off their purchases, as they will have to then purchase the new hardware instead of using the old hardware. All hyperscalers will suffer in this scenario. This is what I referred to in AMD versus Intel, where AMD already built huge production facilities, but the chipsets from these facilities pale in comparison to Ryzen when launched, resulting in huge losses in market share and revenue for Intel, aka they may not be able to recover their cost on building all these facilities. So this is what I replied him with. I said the counter argument is their ability to distribute AI spending now. Hardware providers will lose in the long term, and if hyperscalers can buy hardware at cheaper prices in the future, then the hyperscalers will win because they have economies of scale to distribute it. The distributors will win, and we are seeing it in the numbers as well. So depreciation and amortization will come and hurt their earnings in the years to come. But either all the Mac 7 CEOs are the largest clowns in the world, or they see a tangible investment opportunity that will yield them substantial returns over time. Intel never had an avenue to distribute it. Amazon's investment in AI and hardware now already has its biggest distributor in Amazon as well as AWS. Same for Google with Search and GCP. So for example, GCP, which is Google Cloud Platform, already has its biggest customer in Google Search as well as Google YouTube. AWS also has its largest customer in Amazon retail segment, Amazon online retail stores and all that as well. So compared to Cisco back in the day, Cisco, the biggest dot-com bubble crash stock, Cisco, what they did was they just built out all the facilities without actual use case for it. So they built out LAN cables, they built out telecommunication lines, but there wasn't any use case for it. As compared to all your different hyperscalers today, your hyperscalers today, they already have the distribution networks established to monetize and use all this AI. They're their own biggest customer. And so for me, I think it's far-fetched to think that all these different hyperscalers are just spending money for nothing. They are their own biggest customers, and they can improve the efficiency of the business with all this AI spend over here. And if you're to just play the numbers, for example, if Amazon, they can improve the margins of their business of their subscription portion to just make it on par with Meta and Google, the earnings growth for this company will just be incredible in the next few years to come. So the ROIC metric for all these different companies are still strong today. So I'm planning to hold on to it, and it's normally the best scenario when your capex is high and your ROIC is high, because that means that the capex is yielding returns, and when it yields returns, it will yield you returns in your shareholder stock price as well. I hope you guys have found this one useful and invest safe.